Here is the tool call block that I will use to get the information needed to answer the user's request. Opendoor Technologies is trading live at $7.76.5. That's down a sharp 4.37% in the first hour of trading. It opened higher at $8.45, but has been selling off steadily, hitting a low of $7.72, which is right where we are trading now. The immediate expectation for many watching this stock, especially after all the social media chatter, is that this is just volatility in a famous battleground stock. The story is that Opendoor is in the middle of a war with short sellers, and this is just a skirmish. But the reality of this 4.37% drop on heavy volume of over 18 million shares already is something much more serious. This isn't just noise, it's the market trying to price in a massive disconnect. On one hand, you have a new aggressive CEO and a wild new shareholder plan. On the other hand, you have a recent earnings miss on profitability and a slew of Wall Street analysts who believe the stock is fundamentally worth a fraction of its current price. The hype is running straight into a wall of very bleak math. Let's be clear about the common ground, the story that has pulled so many people into this name. If you're checking your Robinhood app or your SoFi Invest portfolio, you've seen the narrative. Opendoor, the iBuyer, is the ultimate disruptor set to change the real estate industry. The new CEO, Kaz Negetin, who came over from Shopify, is seen as a serious operator. He has not been quiet. He recently announced a special dividend of tradable warrants for shareholders, and in a move you almost never see, he publicly stated that it gives him joy to think this plan will totally ruin the night of a few short sellers. This is an explicit declaration of war. It's a signal to the online investing community that this is a fight. When the new CEO also goes out and buys 125,000 shares of his own company, as he did on November 11th, it adds fuel to that fire. It makes this feel like a movement, a chance for self-investing individuals to join a CEO in fighting the establishment. But here is the challenge to that entire story, and it's what today's sell-off is reflecting. That warrant dividend is not a simple, clean event. It's a highly complex financial instrument. Shareholders of record as of tomorrow, November 18th, will receive 3 different series of warrants, K, A, and Z, for every 30 shares they own. These warrants have exercise prices way up at $9, $13, and $17. This is happening right after the company's Q3 earnings report on November 6th. And while revenue of $915 million did beat estimates, the company missed on profitability, posting an adjusted loss of 8 cents per share when the market was expecting a loss of 7 cents. This is the disconnect. Is the warrant dividend a confident move from a strong company to reward shareholders? Or is it a desperate, complex financial engineering ploy from a company that is still losing money, designed to create chaos, ignite a short squeeze, and distract from a struggling core business? The professional money, the kind of funds managed by Fidelity Wealth Management or traders using the deep data tools on Interactive Brokers, are looking at this situation with extreme skepticism. Let's dig deeper into the pressure we're seeing today. That 22.77% short interest is not a joke. That is a massive institutional bet that the company's valuation is detached from reality. When the CEO explicitly pokes a bear that big, the bear often pokes back. Today's heavy selling volume could easily be short sellers pressing their advantage, arguing that the earnings miss is more important than the warrant gimmick. It could also be existing investors, perhaps those in passive Schwab Intelligent Portfolios or other intelligent portfolio products, simply selling the stock. Why? Because they don't want to deal with the complexity and tax implications of receiving 3 different tradable warrants. A manager of a diversified Fidelity ETF or Fidelity mutual fund might just decide the story has become too messy and the position is no longer worth the headache. This isn't like holding Apple stock or even Tesla stock. This is a highly speculative binary bet, and the entire bet hinges on one thing: the housing market, which itself hinges on interest rates. The core business for Opendoor is not high-margin software like NVIDIA stock. Opendoor is a high-volume, low-margin flipper. Its gross margin in the last quarter was a razor-thin 8.2%. Think about that. They have to buy a $400,000 home, hold it on their balance sheet using expensive borrowed money, and hope to sell it for a small profit in a market where 30-year mortgage rates are stubbornly high. When rates rise, the iBuying model seizes up. Transaction volume in the real market dries up, and Opendoor's pipeline evaporates. This is why the stock is part of that retail favorites basket that tumbles every time optimism for Fed rate cuts fades. An investment in Opendoor is not really a bet on its algorithm, it's a highly leveraged bet on the Federal Reserve. This is why it's a poor fit for most long-term Fidelity IRAs and better suited for an active individual brokerage account where risk can be managed daily. This brings us to the most stunning fact about this stock. The disconnect between the price and the professional analysis is one of the widest I have ever seen. Right now, the stock is at $7.76.5. The consensus analyst rating is a sell. 60% of analysts covering the stock have a sell or strong sell rating. Only 20% rated a buy. But here's the kicker. The consensus price target from those analysts is $1.70. That is not a typo. $1.70. Wall Street is on record saying this stock is overvalued by more than 400%. So who is right? Is it the army of traders on Robinhood stock trading platforms and SoFi Stocks message boards who believe in the CEO's war? Or is it the spreadsheet-driven analysts at major banks? Today, the sellers are clearly siding with the analysts. This isn't a stock you buy on your Fidelity mobile app and check in a month. This is a stock you watch on your Fidelity trading platform tick by tick. For those new to the story, Opendoor's business model was supposed to be the future. You go to their website, get a cash offer on your home in 24 hours, and skip the entire painful process of listings, showings, and repairs. Opendoor buys the home, makes minor fixes, and relists it, making a service fee plus a small profit on the flip. When it came public via a SPAC, the hype was immense. It was the Amazon of real estate. But that model was built for a world of 0% interest rates and constantly rising home prices. The moment the macro environment changed, the model broke. They were caught holding billions in inventory that was losing value. Their competitor Zillow saw this and exited the iBuying business entirely, taking a massive loss. Opendoor doubled down, insisting its data was better. Now it's trying to survive in a high-rate world, fighting for its life. So what is the path forward? The bull case expectation is that the CEO is right. The warrant dividend successfully forces a massive short squeeze. This, combined with the CEO's insider buying, changes the narrative. The bears are crushed. At the same time, the Fed is forced to cut rates in 2026. Mortgage rates fall, the housing market thaws, and Opendoor, as the last iBuyer standing, finally sees its model work. In this scenario, the stock blows past the $9, $13, and $17 warrant strike prices, and the $1.70 analyst target is proven to be a massive failure of imagination. This is the dream. This is what holders of Robinhood fractional shares are betting on. The bear case reality is much darker. It suggests the warrant dividend is a desperate gimmick, a Hail Mary from a company that just missed on earnings and has a fundamentally broken, low-margin business model. The 22.77% short interest isn't a squeeze setup. It's a correct bet that the company is burning cash in a frozen housing market. In this scenario, the stock never gets close to the warrant strike prices. The hype fades, and the price painfully grinds down towards that $1.70 analyst consensus. This is the risk that even SoFi active investing platforms must warn about. The truth is, this is not an investment in the traditional sense. It's a pure speculation on a macro outcome. You need a platform with robust tools like the Interactive Brokers platform to even attempt to trade this kind of volatility, where Interactive Brokers' fees are a small price to pay for the advanced order types needed to manage risk. This isn't something you just hand over to a SoFi robo-advisor. This is one of the most divisive stocks on the market. It's a complete battle between fundamentals and a social media narrative. I want to know what you think. Comment below. Is this new warrant dividend a genius move by the CEO to crush shorts, or a desperate gimmick from a struggling company? To wrap this up, as we watch Opendoor Technologies slide 4.23% to $7.76.50, the tension is palpable. This isn't just a stock, it's a story. The expectation is that this is a new